Welcome to the Dream Huge podcast, where we'll talk with real estate investors, entrepreneurs, business leaders, athletes, and more to inspire you with their success stories so you can work hard, never give up, and dream huge. And now, let's start the show.
Yo, what is up, everybody? Welcome to the Dream Huge podcast. Man, super excited for this one today. We love to share success stories from other huge dreamers, folks in the real estate business, entrepreneurs, movers, shakers, influencers, and more. And hopefully these stories will help to motivate and inspire you right there, to also dream huge. And today we are joined by JP for three, John Pavlansky. What is up, JP?
What is up, my man Pete? Gosh, it's a beautiful day. It's Monday. We're just starting the week off, and we're just kicking it off with a great pod today. We're going to talk some investing. We're going to talk a little bit of real estate today, which is definitely our strong suit. So I am super, super excited for our guest today and to talk some investing. But I do have one quick, simple question. Pete, how are you doing, my man?
I'm doing fantastic. I'm trying to talk over the mall intercom right now, as you hear that in the background. So I'm going to mute in between. Our office is here at the Richland Mall, the Ontario Center. So we have Patrick Grimes on the program today. Thank you for joining us, Patrick. Patrick is with PassiveInvestingMastery.com, and he's going to talk about some alternative ways to invest, especially in today's volatile stock market that we're dealing with. So Patrick, tell us a little bit about yourself and what it is that you guys do at PassiveInvestingMastery.com.
Well, John and Pete, glad to be here. Love the energy and love the topic. Dream big. This is going to be awesome. I've had many dreams in my life. Some have worked out, some haven't, but I'd say it's been a net win. So I'm excited to talk about the journey. Passive Investing Mastery, we do alternatives. I lost everything back in 2009 and 10 trying to do real estate, and the subprime mortgage collapse happened. I realized being all in one asset class is not a good thing. I really got my background, cut my teeth in engineering. I'm a machine design, automation, robotics engineer by trade. Probably like a lot of your listeners, a successful, highly paid individual and looking for ways to invest smartly. And so I've just kind of made my way through my journey and found myself at a place where, man, I got to allocate outside of the stock market. I got to make allocations outside of real estate. I got to find those investments which are truly what we call non-correlated, don't rise and fall with the others in your portfolio, ones that don't have the same market fundamentals. That's a little scary because you got to step out further away from your comfort zone. What I found is with each of those steps, I felt more confident and comfortable with my outlook because I wasn't going to be fearing one particular market cycle. And that's what we're all about, educating and offering alternative investment strategies at Passive Investing Mastery.
Okay, so take us down the list of the alternatives. What do you got?
So right now we're focused, we've done a number of things. Right now we're focused on two opportunistic funds. We have an income fund, and an acquisitions fund, both commercial real estate focused. A lot of focus is on residential single family homes when it comes to, call it debt funds or buying. But right now they're not the best buying opportunity. Their prices have maintained fairly high, but where's there blood in the streets today? Right now, there's blood in the streets in commercial real estate. Now, we're not talking about office. Office is like trying to catch a falling knife. I don't know how office is going to recover. In fact, that's like the only asset class we've excluded from commercial in our documents. But we're talking about residential, smaller apartment buildings. We're talking about, call it small balance commercial, the non-served commercial strip centers in certain markets where they've seen really strong resurgence. And also, especially with what we see happening right now with tariffs and post-COVID supply chain issues, there's a lot of onshore going on. So industrial manufacturing and warehousing. And what we found is that through COVID, these operators just got battered and bruised. Their operating reserves got consumed by all kinds of a myriad of issues, from inflating payroll costs and material construction costs, from just skyrocketing interest rates and insurance rates, as well as eviction moratoriums and wild things like that haven't happened before. They own great assets, but they're financially troubled. And so if they need more time, we opportunistically can lend to them, gap and bridge financing at really high interest rates right now. It's the best time in my life to be a lender, right? Especially in commercial real estate. Assets that used to lend 6, 7, 8%, we're lending 12, 13, 14%. And we can be the source of relief by giving them a loan. So we have an income fund, predictable cash flow, loan to current value, not after repaired or after renovated, kind of hypothetical future value, but we have about a 59% loan to value average in our portfolio, which means we're really low risk at that small end of the capital stack. So for all first position loans, and we're pushing out great monthly cash flow by being the source of relief if they need more time. But if operators want out, we have a sister fund, which is our acquisitions fund, and we just pounce and buy it in cash. So those are really opportunistic. And what's super cool about that fund is the growth potential is just huge. You don't have to hold an asset for 3 to 5 years right now if you buy it to make a return. You can just make your return by buying right and holding it for a very short amount of time. And that's what we're doing. We're churning and burning. We're buying mostly in cash, refining, buying another one, selling, trading forward. And inside the fund, we're just going for high growth right now. Both are outperforming. Very excited about that. That's the real estate side. I'll stop there, but then we can go into some of the alternatives even outside of real estate after that.
Yeah, before you stop on the real estate side, let me ask, is there a minimum to get into these funds, and when can an investor expect that return back?
Well, so in all of my investments since I started, they've been 100,000 minimums for accredited investors. We have quite a few offerings. So if you're interested in coming to the table, sometimes we'll slice and dice it. But we do look for people to come to the table with the 100,000, all accredited investors. And then what that means is 200,000 in income as an individual, 300,000 when combined with your spouse, or $1 million in net worth. Now, if you're not one of those, that's okay. Set up a call with me. We host every 2 weeks alternative investing strategy mastery. It's called Mastery Series. And I interview hundreds of different operators all over the place. I can send you and get you pointed in the right direction, help invest in your journey, and also educate you on all kinds of different alts if you're not accredited. But our investments that we offer are for accredited investors.
Beautiful. Beautiful. And what about on their returns? And I assume a lot of these investors most of the time are saying, okay, you got my return, throw it back in. But typically, how long are they looking on returns?
So the income fund is exactly that. It's designed to immediately push out that predictable income. And so we have options which are 90-day short-term hold periods and 6-month or 1-year hold periods, or 3-year lockups, right? So we kind of have a range of options. And it really was me saying, look, I'm always telling people not to keep cash in the bank, even their liquid capital, because banks are failing, that inflation is devaluing the dollar. Put it to work. But I wasn't actually being the source of relief for where you can put it and get a good return. So we created these short-term notes that are fixed interest at 6 months, 90 days, 6 months, and 1 year at 7, 8.5, and 10%. Awesome, reliable cash flow. Now, the point of those notes, though, is that you can either take the cash flow if this is your time for cash flowing, or, as you say, you can compound monthly and reinvest it monthly. If you're really entered for growth, then you don't want to go fixed income and short liquidity. You want to lock it up. So we have a 3-year lockup period for our Class A and Class B, and those have been well over 12, 13%, way above our projections, and that allows you to get a preferred return and a split of the profits. And it's been great. Why? Because this is literally the best time to do debt or buy small balance commercial real estate in my lifetime. I mean, there's really hasn't been a better time. And residential, of course. Residential 2010 and 11. But this is that time for commercial real estate. The acquisitions fund returns is probably, so I forgot to mention that. So we projected over a 30% annualized return by year 3, and we're actually been trending well above that. So we're actually doing really well. I probably won't go too much into it. And I can share the returns. In fact, passiveinvestingmastery.com, and you just hit track record at the top of the website. We publish our monthly and quarterly NAVs, our monthly and quarterly returns for everybody to see. So anybody can always go and see how we're doing. It's full transparency on our website.
Beautiful.
Just love that, man. We were talking about that earlier today. We are living in the age of transparency. So it's right there on the site for all to see, and you can go and pick and choose. It's like you're going to the grocery store, and you can pick out which investment you want to be in and get your return. Warren Buffett says, invest in what you know about. So that is real estate for me. And also, I drink a ton of whiskey and tequila every weekend. So maybe you could help me out with that as well.
Well, it's funny you say that, because tomorrow, Wednesday, we actually have a whiskey and wine essentially an alcohol bev passive alternative investing mastery series session. It doesn't mean we are not offering these in our company specifically, but we host every 2 weeks. And you think about it, just like many of your listeners, all I knew when I started my career was the 401k account. That's all I knew. Nobody told me about anything else. I didn't come from this background where I was educated on money growing up. I ran from a family of educators, and my father had 3 doctorates. My sister's a PhD in clinical psychology. I mean, I really don't have that education. So I was sitting there working, doing automation and robotics projects with some of the smartest people in America. I was in Google, Tesla, Lockheed, J&J, and Abbott, all kinds of doing really cool stuff, new gizmos and gadgets and high-tech robotic solutions. And none of these people knew more than just day trading in stocks, maybe Bitcoin, but they didn't know that there was a myriad of completely different alternatives that they could get into. And so with Passive Investing Mastery, I decided to not just sponsor deals, but I also decided to just show my hand. Hey, these are the baseball cards of alt assets I've been trading with a couple of dudes for the last, 10 plus years. Let me just show my whole hand. And that was so well received, we decided to just show the whole deck. And so now every 2 weeks, we dive into a completely new topic, whether it's parking lots or gold mining or technology metals or Forex, right? Trading or art, or as you say, bourbon barrel cask, alcohol bev brand investing, or agricultural investing, right? There's a million different ways. We've had land investors. We've had affordable housing. We've had mobile home parks. We've had storage units. Just about everything that you can think about. And if you think of one that we don't have, let me know and we'll get it back on. And that's just me just saying, look, as you say, Pete, people hear this kind of age-old adage, don't invest in what you don't understand. That doesn't mean you don't invest. That means you lean into what you don't understand and you get familiar with it. Why? Because that sense of comfort that keeps you doubling down in one specific thing, that's actually the source of fear you have at night when you're worried about the next stock market crash or you're worried about the next real estate crash, because you're entirely dependent on maybe one market cycle or two. But what if you allocate it into legal? That's why we do litigation finance. Or what about medical? Or what about education? Things that people don't really think about. Or CPAs needed in recessions, or HVAC or plumbers. We figured out these alts that are recession resilient. They don't ride the same fundamentals as the rest of your portfolio. Your pie chart of your allocations begin to get more stable. Stepping out into something that seemingly seems fearful in the beginning, or might be a bit of a risk because you're educating and learning about something completely fundamentally different. That's actually what leads to what we talk about. It's not just financial independence, but financial stability, because now you have pillars of your wealth in different markets that if one washes away, your house is fine. Maybe you don't lose your shirt like I did in 2009 and 10, maybe a button. And that's what really we talk about, true financial security being. And it's not until you get there that you can really feel that sense of ability to not only have the financial independence or abundance, but that you can give back to the causes you care about most: family, friends, hobbies, have the location freedom to be able to move to places like where I'm at now in Honolulu. And so it takes those kinds of steps.
Absolutely. And that's what I was going to do next too, is dive into a little bit of your story, Patrick, because specifically you mentioned that in 2009, 2010, you lost it all, especially at least your investments in real estate. So tell us a little bit about that. What changed during that crash, what your unit count looks like, what your property looked like, and what it looked like after the crash.
Also, in 2009 and 10, in 2006, I was a snot-nosed engineer, started at my first, machine design firm. I had worked at the Toyota plant for a little bit, which is now the Tesla plant. And then I had worked for Gallo doing wine, back to Pete's comment about wine and alcohol investing. And I actually did some robotics projects for the largest winery in the world. So I was doing all right. And then I started at a machine design firm because that was really my passion. I'm a thoroughbred geek. Yes, I'm born and I lived a geek. And at this point I have a master's in engineering and an MBA. I wish I was still doing it, but I'm not. But so I was doing well, and I went to the founder of the company that I worked for and said, hey, look, where should I invest? And I thought he was going to say, like, go to this startup or that startup because, we have the inside track, and that's how I've made my millions. And this guy ran this incredibly profitable and successful high-tech firm for like 3 decades by that point. And so I was really excited to just be able to get his attention and learn from him. As I said, I didn't really have any financial education growing up. And he threw me for a loop. He said, don't invest in high tech. He said, I've ridden that wave my whole life. He said, I've made my wealth by making my money in high tech and then dumping it in alternatives. Invest all of it into real estate and others. And he said his only regret was not investing more sooner. And I was just so floored. So that's how that happened. How did it all come crashing down? Well, I was giving it the old college try. I was a snot-nosed engineer, just not knowing what I was doing. I was really eager to double and triple my money. I did do a bunch of analysis and research, and I looked at a bunch of strategies, and I chose. It was real estate. Back then, it was never going to go down, just going up forever. And I didn't know about recession resilient markets. I didn't know about buying assets. I didn't know about the difference between investing and speculating. I invested in a pre-development project and I lost my ass big time. The whole thing overnight just flipped upside down. I was personally guaranteed on the land, and it was only minimally improved at that point. And I think it literally took 10 years for it to recover. But within a couple years at that point, I was paying out of pocket for something that was never going to recover in any foreseeable future. I ended up getting an attorney to help me find the lenders because they had bought and sold my note like 3 times at that point. They weren't doing deals. They weren't doing deed in lieu. So I actually went through foreclosure, and I was able to avoid bankruptcy, but that was expensive in 2 ways, right? Because first I had to work my way out of that. And then the debt forgiveness that the lender, so when you have a debt forgiveness, you kind of work out a deal with the lender, then the IRS will tack that on as your income. And so I had to pay income tax on that. So that was my first experience. It was humiliating. It was battered, bruised. And I was still a successful engineer. So I doubled down in my career at that point and, recovered over time. I failed early, but holy cow, that was tough times.
Yeah, man. I can only imagine that. Do you still, aside from what you do in terms of the passive investing mastery, do you still personally invest as well yourself in real estate at this point now too?
Yeah, so we have 3 funds right now. 2 of them are opportunistic in commercial real estate, not residential, because right now it's the best time to lend or buy in commercial real estate. And so those are specifically opportunistic funds. I have a bunch of real estate investments in my legacy portfolio, and we also do completely different things like energy and legal investing. And that's really where I think a lot of people should focus right now, because I would imagine a lot of people on your podcast are like, okay, they're in real estate, maybe they're in the stock market. But for me, and if you look at the pie charts of the wealthy, real estate is one allocation. Maybe it's 20, maybe 45%, maybe 15 in some cases. But where's the other, 30, 40%? That's not in the stock market, that balances out your portfolio outside of the wild rides. That's why I think litigation finance is one of my single most favorite investment strategies out there, because the legal industry just doesn't care. It doesn't care what's going on stock market. It doesn't care what's going on with real estate. It doesn't care what's going on with gold, oil, and gas. It's like betting with the house at a casino. They always win. And there's even arguments that, people get more litigious in downturns. And although I can't see the data to show that the legal industry goes up when the markets go down, but it certainly doesn't flinch, and it certainly stays strong. And that's why we found a way to serve that industry, just like in real estate, how you serve the industry by housing tenants. You can fulfill a need by lending to operators that want to acquire or improve properties, right? You can lend to legal operators, attorneys, those that need the finances. Why? Because many of them are working on contingency fee, meaning they don't get paid until settlement. Meaning they've got a bunch of skin in the game. They really believe in this. They're participating in it with you, but they're like, hey, look, I want to give access to justice. I want to do a service for those that otherwise can't afford it. And you can participate as a lender in an asset-backed lending strategy, just like real estate or other asset-backed lending strategies. And you can advance funds for them to either market to acquire new claimants or clients, or the operating expenses to get to the settlement. And it's similar kind of conversation with skin in the game and loan to value and liens. So as to Pete's point, only do what you understand. Well, it turns out if you bought a house before, you understand asset-backed lending. And if you just take a little bit of time to educate yourself on asset-backed lending in the legal industry, you'll realize it's almost identical. There's liens, there's financing agreements, there's collateral, there's evaluation specialists, just like appraisers. There's all those same kinds of mechanisms, but now you're in a completely different alt asset. You've got a totally different market allocation and that's governed by completely different fundamentals. And you can go to sleep at night knowing like, hey, look, the real estate and stock market collapses. At least I have this piece over here. Right? Maybe I have some in precious metals, I have some in legal, I have some stuff elsewhere, right? That'll come back to me.
So how does that look on the legal investing side? Do you pick out certain industries? Do you pick out certain attorneys?
Yeah, so just like any industry, there's a myriad of different ways to get into it, right? And so you got to kind of, like in real estate, you could be in mobile home parks, you could be in Airbnbs, you could be in business office, right? And they're all different. And the same thing in the legal industry. There's a huge legal industry with all different ways that people are approaching it. And there's a very narrow focus that we choose to allocate. And just like our debt fund or our acquisitions fund, we're a diversified pool. So investments in the diversified litigation portfolio, that's our investment. Once you invest, you become a position in all of them. So you're immediately diversified in all the allocations investments. And the specific way we tackle it is like, well, I don't want to do anything speculative. Just like in oil and gas, there are wildcatting. And I don't want to do that. And just like startups, there's seed funding or angel investing, right? Actually, I don't want to go out and venture into the unknown. I probably want to do just late staged cases. In fact, ones that you can get a very clear beat on what they're going to settle for. It's important to know also that 90% of civil lawsuits settle. I mean, it's more of the game of settling anyways, but when you're later stage and you're advancing funds, these attorneys have already got a lot of skin in the game. They've already gone through the court systems to some level, and you've either seen identical or very similar cases already settle, or this actual case is already in settlement negotiations. And these guys are saying, look, we just need there's nothing to lose now. We might as well ramp up our marketing to get as many more people that were similarly harmed on our list as possible so we can settle them together. Or we're almost to the finish line. We just need some additional CapEx or operating expenses, hourly rate, core fees, filing fees. It's a pretty simple industry. It's not like you're investing in the airline industry where it's like massively complex, to get them over the finish line. And so we'll allocate essentially into these investments, into these attorneys, and we'll do a financing agreement with a lien. We'll help them help other people get access to justice. And then when the settlements come back, we get a preferred position on the settlement amounts before a borrower. First, the claimant, the person that was harmed, gets it, usually 50 to 60%. And then the remainder then goes to the attorney, and we would get a preferred position on that. And then you do that across a lot of different cases, a lot of different individual lawsuits, and you get a great non-correlated diversified return.
Beautiful.
That's a new one, JP. You heard of that one yet?
That is a new one. No, I haven't heard of that one. I have not. That is a new one. And this is all accredited too. So for the viewers out there too, Patrick, accredited. What does that entail for an investor?
Well, like I said, if you're not accredited, I'm still happy to talk to you. Everybody starts somewhere. And I actually give away, at the end of this, I'm happy to give away a copy of my book. And I tell my whole story for when I started out non-accredited, losing my ass in my first deals, the trials and tribulations, the ups and downs, and how I escaped the job and to be a full-time investor. So I'm with you. I've been there, I've done that, and I worked my way into being an accredited investor. So if you're not, that's okay. Still happy to talk to you. In fact, happy to educate you. Jump in our mastery series every 2 weeks. You're going to learn about new, completely different alt assets from 2 or 3 panelists. But if you're not accredited, what accredited means is it's defined by the Securities and Exchange. And there's actually some other ways you can get there now by passing a test. But the simple explanation is that if you're an individual kind of arbitrarily that makes $200,000 in income a year for the past 2 years, or combined with your spouse, you made $300,000 for the past 2 years, or you have $1 million in net worth, not including your personal residence. And so those arbitrary numbers is how the SEC says, okay, you can invest in this offering or not. And the reason why we do that is because if we don't limit it to accredited investors, I can't talk about it. You can't publicly solicit. I couldn't sit here and tell you about my investments if I didn't file with the SEC as a Reg D 506C and only limit it. So somebody's got to get out there and talk about these things and tell everybody they exist. But turns out I actually know a lot of people that do investments for non-accredited investors too. So I can be that conduit. If you want to let me know, I'm happy to get you pointed in the directions of the other people that can't solicit and can't advertise.
Fair enough. Fair enough. And it's easy enough. Yeah, some very unique ways to diversify your money. You know, like we said, we're real estate guys for the most part, but still have some diversified, you know, money in other avenues as well. So yeah, Pete, what else you got?
No, I think that's good. That gives us a good overview of everything that Patrick is offering. We're coming up on 30 minutes here. So I just want to see if either of you guys want to throw out any closing thoughts and we can wrap it up.
Yeah, sure. So investwithpatrick.com, investwithpatrick.com. On that, I actually provide a download. It's a free download. And this is kind of by popular demand. I keep getting asked the same question. And it's, what are your, okay, sure, you say I should go diversify in alternatives, but what are they? And it's, what are Patrick's favorite alternatives? Alternative investing strategies. Outside the stock market and real estate, there's a couple real estate in there. But what are my favorite alternative strategies that anybody can immediately go diversify into, can immediately go invest into, that helps to build these pillars of stability that aren't all governed by the same market fluctuations? We just had a massive downturn in the stock market, right? We just had a massive downturn in commercial real estate, right? And we've seen massive downturns in residential. Gold is going up, right? You're going to see things in there like precious metals investing, your technology metals. You're going to see legal funding. You're going to see some weird things in there like life settlements. You're going to see some things about energy, about oil and gas, royalties explained versus working interest and the tax advantage. You're going to see a lot of cool stuff in there. But if you have any questions, passiveinvestingmastery.com. We have our investments at the top. Right on that homepage, you can schedule a meeting with me. And I do give away a book, like I said. If you would like, I could offer it to your listeners. Yeah. Okay. So it's called Lessons from Thought Leaders, and I wrote a chapter in it. I'm on the cover. The book's out of reach right now for me, but it's pretty cool. There's a bunch of really awesome people in there. In fact, Phil Collins, the lead guitarist of Def Leppard, did a chapter. It was really fun working with the group to put this book together. There was some NFL, NBA players. There's some entrepreneurs, actors, really amazing. There's a Navy SEAL in there. Just such a cool book, really fun project. I tell my whole story, the ebbs and flows, the ups and downs, how I lost it all, how I made it back, my journey through single family, apartment buildings, energy, all kinds of stuff. If it resonates with anybody else and it helps you along your journey, it's enough for me. And we really offer it in two ways. If you go to passiveinvestingmastery.com/book, passiveinvestingmastery.com/book. That's the secret link, right? There's not another link like that. Put the name of this podcast inside the offer code at the bottom. We actually don't send these out for people that we don't know where you came from. If you're random form fill, sorry, we're not going to send it out. But if you do, you can either choose to download the ebook or download the ebook and get a hard copy sent to you. I actually sign them and we send them out. And that allows you to actually physically have this book. You can see all the cool people. You can read about their journeys, and one of them is mine. And like I said, my whole goal right now is to educate people in mastery in the art of passive alternative investing so that you can gain not just financial independence, but stability through non-correlated investments and the abundance to contribute to the causes you care about most. And if this gets you along that journey, then it's enough of a thanks to us. And if I'm a stop along that way for a conversation or to take a look at your investments, I would definitely appreciate and be delighted to speak with you.
Patrick Grimes, helping people succeed through passive investing in all types of different vehicles. Appreciate you, Patrick, for coming on today. JP, thank you for making the time today. Make sure you check out investwithpatrick.com and also passiveinvestingmastery.com. Thank you everyone for watching and listening to the Dream Huge podcast. Please remember to like, subscribe, and share. And as always, remember the rules. Work hard, never give up, and dream huge, baby. Let's see the guns, Patrick. Well, there you go. All right. Thanks, guys. Appreciate it.
Thank you for listening to the Dream Huge podcast. Make sure you subscribe so you don't miss any future episodes. For more inspiring content, follow us on Instagram and Facebook at Dream Huge Realty and on TikTok at Dream Huge Inc. Until next time.